week, Uganda passed a 48 trillion shillings budget, and a bulk of this is expected to be mobilized from the services subsector. Of course, this gained a lot of currency during the lockdown when we shifted most of our activities, economic that is, into digital spaces. But of course, key in this is that focus is going to be paid at improving the tax management and collection aspects other than introducing new taxes. This is Money and Markets, and I'm Charles Sport, your host. Welcome to the show. Now, we all know that agriculture is the backbone of Uganda's economy. But of course, we tend to lose it at the way we do it. We can no longer do it the way we've always done it. That's why the sector still needs resources to get it from the point where it is to a fairly commercial activity where it should actually be. And today we're looking at what development partners are doing to bolster the sector's performance from the financing side of things.
So we are the Danish investment fund for developing countries, and we are what you call a development finance institute. So we invest around the world in developing countries in projects that can give a commercial return and can give an impact, a social impact or in an environmental impact. So in that function, you can say we are always looking for good investments that fits our criteria. And of course, this business here with AB Finance, that's a special case because it has been founded by the Danish government, and it's an organization that we knew well already. So it was kind of, can you say, a natural thing for us to look into this and to go into this investment because it fits very well with our requirements for new investments. So I think what we like about this investment and like about AB Finance is that it's kind of a business that works on commercial terms, is in the market to some extent as commercial terms, but still has the focus on creating impact, have the focus on helping farmers and helping small-scale businesses. And you could say that's the same balance that we're looking for when we're looking for new investments. That you could argue that if it was purely commercial, then there was no need for us, then others should do it, right? If it was purely impact, then it's something for development aid organizations. So I think it's the balance, it's the split that we are looking for, and that fits very well for us. So I think our intervention into AB Finance, of course, what we're doing with that is mainly to scale the current business. So what AB Finance is doing already is, as mentioned, that's the wholesale financing, right? Helping the banks and the financial institutions to have capital enough to support the financial institutions to provide loans and guarantees for the farmers and for the businesses. And with our new capital, we are able to expand that actually. So I think that's from our point of view, that's the main thing for us coming in. That is to scale up the current business, which we think has a lot of impact and really supports the market. Both actually, I think the beauty is also here that it supports really the farmers and the small businesses, but it also, of course, to some extent supports the financial institutions, and it really helps to develop the whole network of financial institutions in Uganda. And I think that's very important part also of this business, and one reason for us being involved. One of the products that are provided by AB Finance is the agricultural loan guarantees, right? That actually covers takes some of the risk away from the financial institution and put that instead of AB Finance. And of course, with the new investment, it is possible to expand the level of the number of guarantees that are provided, and that will increase the risk being taken by the financial institutions. So having more guarantees means that they can take more risk in the market, means that there are more farmers and small businesses getting loans. We have our own, in our investment fund, we have our own criteria that we have to reach in terms of, you can say, the total greenhouse gas emission on our portfolio, for instance, on companies. So that means that it's something that we measure now. Going into a new investment, investing in some business, we will take into account the greenhouse gas emission coming from that production. So that's an important thing, and that's really something also where we see that that Abbey Finance can add something to the market, and obviously it's to avoid the climate change, right? I think the climate change, they have also been kind of visible here in Uganda, and to avoid that, of course, we don't want our investment to develop to more greenhouse gas emission and to worsen that climate situation. We want to do the difference. We want to do the opposite. We want to do special products that will incentivize farmers and businesses to invest, to do investments that will reduce the greenhouse gas and thereby on the long term reduce also the negative climate effects.
We all appreciate the fact that we live in a very tough economic environment today. Of course, characterized by low demand, but then also the shilling is depreciating quite significantly against the dollar, and then the high fuel prices. But amidst this, the taxman is expected to collect more, as we've already heard, to bet or to make the 48 trillion budget a reality. How this is going to happen is the focus of this segment. Uganda last week rolled out a 48 trillion budget with optimism that better tax administration and management will see the tax collector realize what appears to be an aggressive target in a tough year. The Uganda Revenue Authority's target was moved up by 3 trillion shillings.
The key anchors for next financial year will be revenue collection, enhancing the revenue collection, and if you saw from the numbers that are coming through, the collections from URA are projected to be up by about 3 trillion, from 20 trillion this coming the current financial year, to about 23.7 trillion next financial year. That's about 59% of our expenditures next financial year.
While economic activity appears generally dampened, government remains positive that the services sector will continue to expand as the world embraces more digital spaces for business.
The good news is, from the results of the opening of the economy, we see that the economy grew to a GDP size of 162, is projected to grow to 162 trillion this financial year, at the end of this financial year, up from a GDP size of about 146 trillion last financial year. And the good news is also that the services sector contribution to the GDP is forecast to be about 41.5% contribution to GDP.
To the taxman, emphasis is going to be placed at better tax administration as opposed to expanding taxes.
You will be surprised that even as the URA, we are very glad that no new tax measures were introduced in this financial year. Because we are coming from the background, we saw how COVID did affect the businesses. We saw how businesses were indeed struggling. We had a number of taxpayers coming through and requesting to pay in installments.
One of the areas URA is targeting to meet revenue collection targets are the huge digital multinational players that pick income from Ugandans without remitting any tax.
I also like the fact that the URA is going to go to Amazon and claim VAT. If I spend on Amazon, not to just look at me, who is paying payee and so much, let them also collect from these guys, Amazon, Netflix. I think those are good initiatives to take away the tax burden.
This optimism is however coming at the back of a gloomy market projection, conditioned by the increasingly weakening shilling against the dollar and the high fuel prices which threaten to escalate inflation.
Where I sit, our own currency valuations by end of Q1, looking at the supply, demand dynamics, looking at the strength of the dollar, looking at interest rate differential, looking at geopolitical risks, we put it at around 3,950 by end of Q1. That has implications. It looks like a weak currency will, of course, drive inflation going forward, because imported inflation, we are net importer. But to even add salt to that is the crude prices. If they continue remaining where they are, and which is likely to happen, we are going to demand more dollars to import the same quantities of oil than we're doing now. So that has a very, very serious implication.
Faced with an already tough economic environment characterized by low demand and rising inflation and a weakening shilling, the taxman has a tough journey ahead, one that will involve a tough balancing act of protecting business growth, but at the same time, work to meet the collection targets. We'll now take a very short commercial break. Money and Markets continues after this break.